Imagine being in the market for like 44 years through Black Monday, the dot-com crash, 2008, a literal global pandemic.
Yeah, that is a whole lot of volatility to survive.
Right, and in all that time managing billions of dollars, you've only ever had 5 down years.
It's honestly incredible.
And your absolute worst drop.
Yeah.
Ever. Just 10%. But here's the hook for you listening today. This exact investor is looking at the artificial intelligence boom right now, and he is seeing a massive, dangerous bubble.
Yeah, the man who basically never loses money is terrified of the biggest tech revolution of our lifetime.
Exactly. So today's deep dive is all about pulling apart this paradox. We're looking at a highly revealing interview with Seth Klarman,
The legendary founder of Baupost Group.
Right. The interview is on the iConnections YouTube channel, and what he laid out isn't just, a basic critique of AI hype.
No, it's a masterclass in how to invert the way you think about risk. Because in an ecosystem where everyone is obsessed with, like, catching the next rocket ship and maximizing upside, his entire superpower is an absolute obsession with the downside.
So before we get into his brutal warnings about AI, I feel like we have to understand the mechanics here. Like, how does someone actually survive 4 decades of crashes with a near flawless record?
Well, you do it by making structural safety your absolute baseline. Like, most investors look at a stock and ask, how much money can I make if everything goes right?
Right. The upside?
Exactly. But Klarman looks at an asset and asks, how much money will I lose if everything goes horribly wrong? So he refuses to use leverage.
Oh, interesting. So no borrowing money to amplify returns?
None. Because borrowing money is the fastest way to get wiped out in a downturn. Beyond that, he demands a huge margin of safety on every single bottom-up analysis, and he is perfectly willing to just sit on cash for long periods if he doesn't see a deep discount.
I actually want to pause on the mechanics of that structural safety for a second, because I know he also relies heavily on something called senior securities.
Yeah, he does.
For anyone listening who isn't deep into corporate finance, what does that actually mean in practice?
So it comes down to the literal legal order of who gets paid if a company goes bankrupt.
Okay.
When a business issues both stock, which is equity, and bonds, which is debt, the debt is considered legally senior to the equity.
Right. They're at the front of the line.
Exactly. If the company goes under and has to be liquidated, the courts ensure those debt holders get paid back first from whatever cash is left. The stockholders are at the back of the line.
And they usually get nothing.
Right, basically zero. So Klarman frequently buys the senior debt of a company. He's legally insulating himself. Even in a worst-case scenario where the business fails, his position in the capital structure means he still gets his money back.
Wow.
And, combine that with cross-asset macro hedges, like buying put options that pay out if the broader stock market crashes, and he essentially caps his maximum possible loss.
It's like playing a sport where your entire strategy is just refusing to give up points, right? Knowing the other team will eventually get tired and make mistakes.
That's a great analogy.
But I have to ask, why is this strategy so rare if it's clearly so successful?
Well, as Klarman points out, talking about downside just isn't sexy. I mean, it doesn't play well on financial TV during a roaring bull market.
Yeah, nobody wants to hear about crash protection when everyone else is getting rich.
Exactly. But protecting your capital when times are euphoric means that when the market inevitably corrects, you actually have dry powder. You can aggressively deploy money into the bloodiest environments.
Because all your competitors are too wounded to act.
Right, or just too terrified. Which is when you buy incredible assets at fire sale prices.
Which brings us perfectly to the biggest, shiniest object in today's market, right? Artificial intelligence. Klarman explicitly states this current environment has the characteristics of a bubble.
He really does.
He points to this sort of optimistic new era thinking that always accompanies financial manias. And his primary piece of evidence for this is honestly kind of hilarious.
Oh, the Allbirds indicator?
Yes. The shoe company, they literally added the letters AI to their corporate name, and their stock price jumped.
It is the exact same psychological phenomenon we saw in, 1999.
When companies would just add .com to their names and watch their valuations explode.
Yep, completely irrational.
But let me push back on Klarman's premise here on behalf of everyone listening. During the .com boom, the internet actually did change the world.
It did.
And isn't AI actually game-changing? I mean, Klarman himself admits in this interview that generative AI could cure diseases or read X-rays better than human doctors.
Right.
So if a technology is genuinely world-altering, how can investing in it be a bubble?
Well, the answer lies in this concept called multiples versus uncertainty. And this is perhaps Klarman's most profound insight for anyone evaluating the market today.
Okay, break that down for us.
Think about how a financial multiple works. A multiple is simply the premium you're willing to pay for a dollar of a company's earnings. So if a business makes $1 a year and you pay $20 for a share, you are paying a 20x multiple.
Got it.
In traditional finance, if you face massive uncertainty about a business's future, you demand a lower price, right? A lower multiple to compensate you for taking on that unknown risk.
Because if I don't know what the future holds, I'm sure as hell not going to overpay today.
Precisely. Now, apply that logic to AI. We are facing ultimate uncertainty right now.
Oh, for sure.
We don't know if these models will hit a performance wall or achieve actual AGI. We don't know if the long-term winner will be Google, a startup, or some open source model.
We don't even know how it'll impact global employment or copyright law or inflation.
Exactly. Logically, that incredibly high level of uncertainty should force the market to demand lower multiples. But instead, the exact opposite is happening.
People are paying 40, 50, or even infinite multiples.
Right, for companies with zero profit, based entirely on this distant, unpredictable future. So, what's fascinating here is that the bubble isn't necessarily the technology itself.
It's the price tag.
Yes. The bubble is the absolute certainty that investors have priced into the valuations despite the reality of massive uncertainty.
So for you listening, if you're looking at an AI stock right now, Klarman's framework really forces you to ask, are you paying for the current reality, or are you paying an astronomical premium for a complete mystery?
Exactly.
But here's where it gets really interesting. Klarman isn't avoiding the space entirely, right? He actually owns Amazon and Google. I think they make up about 10% of his entire book.
He does, yeah. But his reasoning is completely stripped of the hype.
Right.
I mean, he didn't buy Amazon and Google because of their large language models. He bought them because they are, in his words, enormous cash flow machines with highly versatile cloud data centers.
And he didn't buy them at peak hype either.
No, he waited for brief windows of market panic, like the tech sell-off a couple of years ago, and he bought them at below-market multiples.
So the downside was protected by their existing massive retail and search businesses.
Exactly. He didn't have to make any heroic assumptions about the future of AI to justify the price he paid.
Contrast that with the companies he's aggressively avoiding. The massive foundation model companies, like OpenAI and Anthropic.
Yeah, he stays far away from those.
Because their business models currently require, incinerating billions of dollars just to train their models and stay relevant.
Yeah.
He makes a great point that a business forced to constantly set fire to its own cash just to survive is not Warren Buffett's definition of a great business.
The capital expenditure required is just staggering. And Klarman asks this critical question, is this actually a winner-take-all market?
Right, what if it's not?
If open source models just commoditize the technology, these huge companies might never recoup those billions in training costs. The uncertainty is simply too high for the valuation.
But the most Seth Klarman play in this whole AI landscape isn't software, it isn't chips, it's raw land.
This is so smart.
He's buying dirt that just happens to be located next to massive power substations. I mean, here's the analogy. He's not even selling pickaxes during the gold rush. He's buying the dirt where the pickaxe store eventually needs to be built, simply because he confirmed it has electricity.
It is just a brilliant exploitation of physical reality over digital hype. You know, we think of AI as this invisible code in the cloud, but the cloud lives in physical data centers.
Right. Very physical, very power-hungry building.
Yeah, a single AI data center can require as much electricity as a small city. You cannot just plug that into any neighborhood grid.
No way.
Building new power plants takes a decade. Navigating local environmental permitting for massive transmission lines takes years. The power grid is the ultimate physical bottleneck.
So by buying that specific land, he is basically holding the bottleneck.
Exactly. He is creating valuable optionality. He pays very little for the raw land. If the insatiable demand for data centers continues, tech companies will be desperate for land with existing power hookups.
And he can lease or sell it to them at a massive premium.
Right. But if the AI boom fizzles out, he still owns a piece of land with valuable infrastructure. And because he didn't overpay, his downside is virtually zero.
He also applied this structurally safe approach by buying into a private, non-China Asian data center venture, right, at a 40% discount to what public markets are paying.
Yeah, he always finds the back door into a trend.
Because, the AI vacuum is sucking up all the capital and all the media attention right now. It leaves massive parts of the market completely ignored.
Oh, absolutely.
With his 40-person investment team, Klarman is out there hunting in the anti-hype. They're looking at AI-agnostic companies, businesses like roofing suppliers or housing materials that won't be disrupted by AI, but whose stock prices are drifting lower just because investors are bored.
They're also targeting perceived AI losers.
Oh, interesting.
Yeah, the market is making these sweeping assumptions that certain software or service-related businesses will just be destroyed by automation overnight.
So the equity in these companies gets clobbered.
Exactly, down to incredibly low cash flow multiples. So Klarman's team steps in, analyzes the actual fundamentals, and often finds that the market has wildly overreacted, which creates a deep value opportunity.
But out of all the complex investments they research, his absolute favorite idea right now blew my mind.
Yeah.
It wasn't crypto. It wasn't some biotech startup. It was assisted living facilities.
It perfectly illustrates his contrarian method, though. Think about the timeline of assisted living.
Okay.
These facilities were totally battered after COVID. Families were terrified to place their relatives in them. Occupancy plummeted, and a massive wave of bankruptcies swept through the sector.
Right. But the underlying demographic reality, like an aging baby boomer population that never changed.
The need didn't disappear, it was just delayed.
Yes.
And because of the bankruptcies, new construction completely halted. So now the bad debt has shaken through the system, the oversupply is gone, and the fundamentals are turning sharply positive.
And most importantly, Klarman is buying these existing assets at significant discounts to what it would cost to build a new one today.
Right, what we call the replacement cost.
Yeah.
If you buy below replacement cost, no rational competitor is going to build a new facility across the street.
Because they could never charge enough rent to make a profit compared to your much lower cost basis.
Exactly.
Now, I get buying physical real estate when it's cheap and the demographics are on your side. But I also saw in the source notes that he buys a lot of distressed debt. Like, he's involved in a Brazilian corporate restructuring and various private equity debt exchanges.
Yes, yeah.
I have to play devil's advocate here. How is buying the debt of a failing company considered structural safety? That sounds like pure gambling.
It definitely sounds counterintuitive until you understand the institutional mechanics of how debt is traded.
Okay, tell me more.
Often, when a company faces a crisis and its bonds are downgraded to junk status, the original bondholders, like pension funds or conservative mutual funds, are legally required by their own internal mandates to sell those bonds immediately.
Oh, wow. So they aren't selling because the bond is necessarily worthless.
Right. They are selling because the rules say they literally cannot hold junk-rated debt.
So they become forced sellers, dumping assets at any price just to get them off the books.
Exactly. That forced selling creates an artificial price crash. Then you have early distressed debt traders who swoop in, catch the falling knife, ride the initial dead cat bounce, and then they also sell.
Because they don't have the patience to wait 3 years for the actual business turnaround.
Precisely. And Klarman loves stepping into that specific secondary vacuum. He operates right below the radar of the massive trillion-dollar gorilla firms.
In that, like, $50 to $100 million range?
Yeah, where the forced selling creates irrational mispricing. He buys the senior distressed debt for pennies on the dollar, knowing the underlying assets of the company are worth far more than what he paid.
It's brilliant, building this fortress from the bottom up, finding cheap real estate and mispriced debt. But no matter how cheap a single asset is, it doesn't protect you if the entire global economy seizes up.
No, it doesn't.
And Klarman is staring at some massive macroeconomic storm clouds that he feels the broader market is willfully ignoring.
He focuses heavily on the geopolitical map, particularly the Middle East. You know, the market treats regional conflicts as background noise, but Klarman looks at the physical choke points.
Right.
He argues that if the Strait of Hormuz were to close due to an escalating conflict, the global oil supply would be choked off. Oil wouldn't just blip up. It could spike to $150 a barrel overnight.
Which acts as a massive immediate tax on every consumer and business on Earth. It would be totally devastating to the global economic landscape.
And you combine that geopolitical risk with the physical reality of the AI build-out we discussed earlier.
Look, right, the materials.
The sheer demand for copper, steel, specialized cooling equipment, and like high voltage electricians to build out these data centers is massively inflationary in the short term. It drives up the cost of raw materials and labor across the entire industrial economy.
And hovering above all of this inflation and geopolitical risk is the ultimate elephant in the room, United States debt.
Yeah.
The U.S. just crossed 100% debt to GDP, and we are adding over $2 trillion a year to that pile. Now, before we cover his observations on this, I want to make it absolutely clear to you listening to this deep dive, we do not take sides or endorse any political viewpoints.
Right.
We are strictly and impartially reporting Seth Klarman's perspective as stated in the source material.
Exactly. And looking at it strictly through the lens of a global investor, Klarman's perspective is highly critical of how the U.S. is presenting itself to the world.
In what way?
Well, he feels that policies spanning multiple recent administrations are making the United States look, quote, unserious to the foreign creditors who actually purchase our debt.
Unserious. That's a strong word for the bond market.
It is. He specifically criticizes the erratic nature of trade policy, where tariffs are abruptly announced and then reversed, creating chaos for supply chains.
Okay.
He critiques the strategy in the Middle East, arguing that executing bombing campaigns without securing lasting peace or demonstrating a strategic endgame shows a dangerous lack of looking around corners.
He also mentions diplomacy, right? Noting that the U.S. frequently alienates top-tier allies like Canada, whom, honestly, any other nation on Earth would draft as their #1 choice for a neighbor.
Yes. And regarding domestic fiscal policy, he critiques the political spectacle of proposing government cuts using what he calls a chainsaw.
Like floating the idea of defunding FEMA or pandemic preparedness offices without making a clear, reasoned, mathematical case for it.
Right. To the foreign creditors buying trillions of dollars of U.S. Treasury bonds, he argues this doesn't look like serious fiscal discipline. It looks like political theater.
And it sends a glaring signal that the country cannot genuinely rein in its structural deficits.
Exactly.
So if the national debt is spiraling, inflation is being propped up by the physical demands of AI, and the geopolitical map is a powder keg. What happens to the traditionally safe investments? Like, where do you hide?
This is perhaps Klarman's most chilling observation. He says the risk-free asset is riskier every day.
Wow.
For decades, the entire financial system has been trained to ignore geopolitics and just watch the Federal Reserve.
Yeah.
As long as the Fed was managing rates, U.S. Treasuries were the bedrock, the risk-free asset.
But Klarman is warning that the sheer mathematical reality of these structural deficits will eventually force a reckoning.
You cannot have the foundational asset of the global economy becoming inherently riskier without it causing massive tremors across the entire stock and bond market.
It is a sobering thought. If the foundation is shaking, you need those watertight compartments more than ever. But to humanize this legendary investor, before we wrap up, I do want to share the one that got away.
Oh, the Palantir story.
Yes, because even someone with a 44-year track record and an absolute obsession with risk experiences, bad luck. In the interview, he's asked about his biggest miss. And 15 or 20 years ago, Klarman's team did all the fundamental work on a $40 to $50 million early venture investment in Palantir.
They saw the underlying value long before the public markets did. I mean, Palantir was doing complex data integration for intelligence agencies.
Right.
They saw the insanely sticky government contracts and the massive moat the company was building. Baupost had the capital, and they were ready to make the bid.
They were at the literal finish line. But the sellers simply changed their mind at the last second and walked away.
Oh, that hurts.
By the time Klarman's team could act again, the window was permanently closed. Klarman admits he missed out on billions, if not tens of billions of dollars on that single stake. It just proves that you can do all the math right, protect your downside, identify the ultimate asset, and still miss the boat because of sheer chance.
But he survived the miss, and that is the real lesson here. His entire portfolio didn't depend on hitting that one Palantir home run. He missed out on billions, but his structural safety ensured he never lost the capital he already had.
Such a good point.
And that leads to a really important final provocative thought for you to mull over. At the end of the interview, Klarman, who's in his 60s, manages tens of billions of dollars and has literally nothing left to prove to anyone, says he plans to stick around and lead his firm for another 10 to 12 years.
Yeah.
If an investor whose entire framework is built on downside protection, structural safety, and sniffing out disaster feels the absolute need to stay at the helm for the next decade, what does that say about the turbulent economic transition we are about to enter?
That is the million-dollar question right there. The man who refuses to lose sees a storm coming, and he is battening down the hatches. It really forces you to look at your own portfolio and ask if you are truly prepared for uncertainty, or if you are just paying infinite multiples for a future no one can predict.
Seriously.
To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community. To track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store.
Disclaimer: all analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for information and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
If you'd like to access wider topics, including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated. So as you navigate this AI-driven market, ask yourself, are you just chasing the upside like everyone else, or have you built your fortress? Keep your downside protected. We'll catch you on the next deep dive.